Most people in Minnesota think their life insurance is fine. They've got a policy through their employer. Maybe they picked something up years ago. But here's what I see in my agency every single week. Families are carrying between 250,000 and 500,000 in coverage. Then we run the actual numbers and they're short by $500,000 or more. That gap between what they think they need and what they actually need, that's the difference between your family being okay and your family struggling. By the end of this video, you'll know exactly how to calculate your coverage number. We use something called the DIME method. Sounds fancy, but it's just 4 categories. D is debt, your mortgage, car loans, credit cards, student loans. I is income, what your family needs replaced for about 12 to 15 years. M is mortgage, your remaining balance. E is education, what you're planning to spend on college for each kid. Add those up, that's your baseline. Then subtract whatever savings you've got sitting around. Let me walk you through an actual family. $75,000 in income. They've got 45 grand in non-mortgage debt. Remaining mortgage balance in Minneapolis suburbs is typically around 285,000, and that's not even counting some of the nicer neighborhoods around the Twin Cities. 2 kids, and they want to help with college costs. When you add all that up, you're looking at roughly 1.3 million in coverage. Most people in that situation, they've got 300,000 or 400,000. The gap is $800,000. That's not a rounding error. Your employer policy, if you've got one, is usually 1 to 2 times your salary. That sounds like something until you do the math. If you make 75,000 and your policy pays 75,000, you've got enough to cover maybe a funeral and 2 months of bills. That's it. Your family still needs to eat for the next 15 years. They still need to pay utilities, maintain the house, maybe get some help with childcare. A stay-at-home parent, people skip insuring them completely. But if that person dies, the surviving spouse is suddenly paying 70, 80,000 a year for childcare and services they were getting for free. That's real money that has to come from somewhere. Here's what I see go wrong most often. People think if they pay off the mortgage, their family is protected. It's a nice idea. Paying off the house is good, but that's not the same as replacing income. Your family doesn't just need a roof over their head. They need to live in that house. Electricity, water, property taxes, food, all of it still costs money every single month for years. I had a client last year, good intentions, had just enough to pay off a $300,000 mortgage. We looked at his situation and realized his real need was closer to 1.1 million. He was thinking about the house. He wasn't thinking about keeping his kids' life stable for 20 years. That's the mistake. You don't have to guess at this. Call us right now at 763-733-7475. We're licensed in Minnesota, Wisconsin, North Dakota, South Dakota, Iowa, Illinois, Ohio, Missouri, Nebraska, Kansas, and Arizona. We can walk through your specific situation, your income, your mortgage, your dependents,